We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Brady. He's money manager, Sprott money contributor, and an expert on all things gold and silver. Thanks for joining me today, David.
Oh, thanks, Tom. Thanks for having me on again.
Excellent to have you back. So you developed the FIPEST XM process. So give our listeners a little bit of a refresher, if you could, on what is contained in it and why the I is so important right now.
Okay, so FIPEST XM, I'll go through each of the initials. F is for fundamentals, I is for intermarket analysis, P is for positioning, E is for Elliott wave theory, and S is for sentiment, T is for technical analysis, and XM, that refers to potential manipulation. And the I that you refer to right now, intermarket analysis, why it's important. I mean, it's important now, but they're always important. Each of them have, the reason why I use them all is that they're all widely used by various participants in the markets. And for that reason, I believe they all have a high degree of credibility. My 2 cents on this is, why limit yourself to one or two when you can use them all? Now, some people will say, well, that takes a lot of effort and takes a lot of time. Yeah, sure it does. But unless you're day trading, it's invaluable to use this process if you're looking over a long term, or should I say, focus on the big picture and swing trading or investing as opposed to day trading. Because when all of these tools point in the same direction, whether it's up or down, you can have a high degree of confidence that you're going to be right in the outcome. And the perfect example for that for me was back in the second half of 2015 when I started buying gold and silver. The rest, shall we say, is history. And so when you say, like, referring to the I in intermarket analysis, yeah, it's particularly relevant now because of what's happening with regard to bond yields, nominal and real, and their impact on gold and silver. But I will say that the backdrop from a fundamental perspective is even more important because that's a bigger picture. And what do I mean by that? What the IMF said recently with regard to telling governments around the world to spend, and then spend some more. I mean, that means fiscal stimulus left, right, and center. At the same time, you've got Biden has already passed got his 1.9 trillion stimulus passed. On top of that, you got the recent FOMC where Powell reiterated his plan to do whatever it takes, which means print more money, which specifically means when the government spends more, they have to issue more debt. Guess who's going to be buying that debt? The Fed. With what? Money printed out of thin air. And then you've got Yellen now as the Treasury Secretary hinting at MMT. Well, you can hint at it all you want. It's obviously what it is. I mean, you've got the fiscal authority, the government spending money, and the Fed printing money to buy the associated debt. So basically what's going on is the central bank is funding government spending directly. That's modern monetary theory. Well, when you combine all of those issues with regard to the money supply, with potential supply shocks, which I've been talking about for a year now since, we had the debacle last March and the lockdowns and COVID-19, etc., that you're going to get more widespread and pervasive supply shocks, not just in North America, but globally. When you combine that with a massive increase in money supply, a greater degree of which is going to go into circulation in the economy, unlike onto the Fed's balance sheet in terms of bank reserves in the past, which is going to increase monetary velocity pretty soon. When you combine those two factors, what you've got is more money, more paper money, chasing fewer goods and services. Economics 101, that means inflation. At the same time, you've got a slowing economy, you've got higher unemployment, and all of this talk about, the economy is going to get better soon. I think that's all hogwash, personally. I hope I'm wrong, but I think it's all nonsense. The economy is bleeding. And the markets are completely, especially the stock market, completely disconnected from what's going on in the economy. So what you've got the recipe for is basically stagflation. On the one hand, prices are going up. And on the other hand, the economy is going south. And the last time we saw this was back in the 1970s. Now, I won't get into details, but all I have to say on this matter is just look at what happened to gold and silver. in the 1970s, specifically from 1974 to 1980. Now take that stagflation and what it did for gold and silver. Gold went up 24x, silver went up 36x. Now imagine what hyper-stagflation does to that. What do I mean? You get hyperinflation at the same time as you get a slowing economy. You can only imagine what gold and silver are going to do. So anyway, I just wanted to say that the F in my FIPEST XM process, that provides the big picture outlook for the sector in precious metals and for all the markets actually. But that's critical for the big picture. The intermarket analysis that I'm looking at now is more from a timing perspective with regard to the low after this long drawn out correction, which you and I talked about back in July of last year, which everybody poo-pooed on. And now I'm getting pats on the back 6 months later. Oh, you're right. Well done. To me, it was obvious, and I gave the detailed rationale for why it was coming. And 3 weeks later, we had the peak in gold and silver on August 7th. Now it's the reverse. People are starting to turn bearish, which is fantastic. This is what we want. We want people calling for 1,300, 1,400, 1,500 gold, because that tells me that the tide is finally starting to turn and that we're getting ready to turn up again. And that's exactly what's going to happen. And that's the sentiment. That's the S part of my 5S process. But with going back to the I, that's with respect to the bond deals. Bond deals called the top in gold and silver in August. Now, meaning that the yields were at a low. Just go look at a chart for the 30-year, which I prefer to the 10-year. The 30-year is a fantastic chart for gauging the next direction for yields. And it's heading back up towards the 100-month moving average, which has been the peak for the past 30 years. You know, it's amazing. It's been tested so many times over that period. That's what gives its credibility. And I said back in October of 2017, I believe, that if we go above that moving average, buy bonds because they're going to go. And exactly what happened. And I said it would go to sub 2%, perhaps even sub 1%. The rest is history. Now we've gone shot right back up and everybody's getting bearish on bonds again. No, when we get back up to that moving average, expect yield curve control, or essentially the Fed capping yields again. When they do that, that puts an asymmetric risk in place for real yields to the downside. What do I mean by that? Yields are capped, but at the same time, the Fed is buying the debt, which means they're printing more money, which is inflationary. It hasn't been inflationary in the past because that money used to go to the bank reserves on the Fed's balance sheet, but increasingly going forward, it's going to go into circulation in the economy. And when you've got fewer goods and services associated with that increased money supply, you get inflation. If you have nominal yields capped while inflation goes up, real yields go down. You only have to go back and look at history to see how real yields correlate inversely to gold and silver. When real yields fall, gold and silver go up. There's an asymmetric risk to the downside in real yields. This is coming. The Fed cannot let yields go beyond 3% in the 30-year. And there's an associated number in the 10-year, I think it's around 1.5%, because the interest cost and the debt will make the insolvency of the U.S. government obvious. And they can't allow that to happen. So you're going to see them cap yields at that point. At the same time, you get inflation increasing, which means real yields fall, gold and silver take off. And it may have already started, but I'm watching, particularly on the daily chart of the 3rd-year, for a negatively divergent higher high. I think we got up to 240. If we got up to 260, 270, ideally 275, but the RSI is lower than what it was at 240, then you've got a negatively divergent higher high, and I'll feel a high degree of confidence that gold and silver have bottomed at that point.
Mm-hmm. So, David, why is it so important for the Fed to control yields? And is there any turning back once they start this process?
No, they're trapped. They have no choice. They've changed their inflation measure to an average of 3% over 3 years, as opposed to the 2%. And so that means that we have to wait like at least 3 years, maybe 4 or 5, until they hit that average of 3%, which means that they're going to allow inflation to run hot. We've known this for quite some time. They can't allow bond yields to go up commensurately with inflation because the debt is massive. The debt load, I mean, what are we at now? 28, 29 trillion in the US. And that doesn't include unfunded liabilities and so forth, and the household sector and the corporate sector. If the yield goes up significantly, 3% or higher, the interest cost alone will be more than the tax receipts in the US. Now, I don't know about you, but my definition of insolvency is that you've got less money coming in than you have to pay out in interest costs. Never mind the principal, you can't even pay the interest on the debt. That's insolvency. Mm-hmm. So the Fed cannot allow that to happen. So they're going to cap yields at that point. And we know this because you can see the Bank of Japan have been doing this for years. It's only a matter of time. They have no choice. Mm-hmm. It's either that or collapse of everything.
So, David, when you're talking about, let's say, a real yield, you define that as bond yields minus inflation. Yeah. And it makes me wonder how, the Fed or any government for that matter is measuring inflation. So how do you think about the actual inflation piece? Do you measure it a different way? Or even if we measure it the way the Fed measures it, is that, enough to get a true measure of where real yields actually are?
Okay, well, there's the official inflation number, and then there's the unofficial, otherwise known as real inflation number. And the official number is the CPI or the core CPI. The core CPI is a joke because it strips out energy, for example, and food, which are two of the principal necessities that people spend money on. Why would you strip those out? Anyway, because they're volatile. Well, it doesn't matter. That's what most people spend their money on. We drive cars, we eat. I rest my case. That has been shown to be relatively flat over recent years, despite all the money printing. However, anybody who has seen what has happened to gold since March 2020, oil, gone to the grocery store, what's happened to the cost of food, knows that inflation is rising. Or look at housing prices. There's so many examples of inflation that it's obvious. And the latest now is just look at the commodity sector in the past few months. Look at soybeans or cotton. I looked at them this morning and it's just amazing what's happened. They're going through the roof. And so when you see the CPI saying it's like 1.9% or the PCE is 1.8%, it just makes me laugh, because when I go and I look at just any chart on any commodity right now, or look at where oil has come from, oil stocks, I was mentioned rig on Twitter the other day, that's gone up 500% since November. Inflation is everywhere. So when they say the official number is 2% and it'll take us a while to get to 3%, I laugh. And if you look, I understand with the lockdowns, nobody's buying Gucci belts. So there's deflations in certain parts of the economy for sure. Commercial real estate, case in point. But in the things that most people spend their money on, especially these days, it's rampant. Lumber is another one. There's so many meat prices. I could go on all day. It's everywhere. So, when we're looking at statistics and we're looking at real yields, the number is nominal yield minus the inflation rate or inflation expectations, depending on which one we'll use. Well, if you're using the CPI, it's overstating the real yield. If you are using the unofficial inflation rate, for example, Shadow Stats has it around 8% to 10% annually. Real yields are a heck of a lot lower. I think the way to look at it, so you don't get bogged down in the absolute numbers, whether it's CPI or Shadow Stats number or somewhere in between, is actually to look at the change in expectations. What I mean by that is, if people expect more inflation going forward, you're going to see real yields drop. If people expect less inflation going forward, you're going to see real yields rise. And it's the rate of change as opposed to the absolute number for me. And that is what will impact gold and silver. But given the coming cap on yields, which is inevitable in my opinion, because the Fed has no other choice other than collapse of everything, there's an asymmetric risk to the downside in real yields, and therefore gold and silver are going higher. It's as simple as that. It's just a question of when. And given the correction that we've had since August of last year, I think we're close. I think we're very close to the bottom here. If it's not already in place, we'll know in the next few days, weeks at most.
Mm-hmm. So just to reiterate, David, you're saying that when the nominal bond yields peak, then gold and silver will be at a real bottom, correct?
Well, here's the issue. If you're using the CPI, which has been flat since the dawn of time, at 2%, then by definition, if real yields are equal to nominal yields minus inflation, and the inflation number is a constant, then real yields are driven by nominal yields. So if nominal yields go up, real yields go up. If nominal yields go down, real yields go down. And based on the official numbers, that's exactly what's happened. Because you just go look at what the 10-year yield was on August 6th, 7th, and the same for the 30-year, and what happened thereafter, and then look at what happened to gold and silver. They're polar opposites. Mm-hmm. The 10-year yield went up, the 30-year yield went up from a low in both cases, and the gold and silver peaked and went south. Mm-hmm. And given the nature of CPI and its use in the determination of real yields, nominal, real, they're pretty much the same thing these days. Mm-hmm. And that's why I'm saying that based on the official numbers, they're the same thing. And that's why when the 30-year yield peaks, 10-year too, but the 30-year real yield peaks and falls, then the real yields will do the same and gold and silver are going to take off, in my opinion.
So, David, when you're talking about that peak, what will constitute that for you? Are there any, particular targets that you have, or you just need to see the rollover and the heading lower?
Well, as I said earlier, if you look at the daily chart for the 30-year, we had the 30-year RSI reach its highest level since, I believe, December 2016, which was also the low in gold, if you recall, at 1124, which we've never seen since. And it's come off since, back to an RSI of 67. I think it got to 84. It's fallen back to 67. If we see a higher high in yields and any RSI below the level of 84, the prior peak, you've got, by definition, a negatively divergent higher high in yields. That, to me, will signal that the peak is in or close in the 30-year. And then from there, if you see it drop, then you know that the peak is in place for yields. And by the same token, gold and silver have bottomed. Now, they don't have to happen on the same day, mm-hmm. but I'll take a bet with anyone. If you see the 30-year go from, say, 275 down to 2% or 1%, gold will have gone to $2,000, $2,100, maybe $2,300 plus.
Excellent. So how does the value of the dollar play in here as well, David? Don't we see that there's typically a divergent relationship there as well between a higher dollar and the value of gold?
Yeah, but that, the confusion is people try to apply that on a daily basis, a weekly basis, or even a monthly basis. And the gold is the anti-dollar. That's the reason for its suppression over the past 20, 30 years. A rising gold price undermines confidence in the dollar. Gold works inversely to the dollar long term, but don't get bogged down in the short term, the daily, the weekly or monthly moves. So, if you go back to the 1970s, you can clearly see that when the dollar goes up and the gold goes down and vice versa. And the reason I say this is the correlation comes and goes in the short term. Mm-hmm. And I think people are going to be surprised when they see, this is a scenario I see that could play out, that when real yields start to fall again, when nominal yields fall, we could have a very strange scenario where the dollar goes up and gold go up at the same time. And people are going to be scratching their heads. How is this possible? Well, I'll say again, the correlations break down in the short term. Case in point, until very recently, the dollar's been falling. It's been falling since March. And gold went up, but gold peaked in August. So since that August peak, gold and the dollar have been falling together. They've been going in the same direction. Now, I think that they can go up together too. And one of the reasons I believe this is, and forgive my nomenclature here or the words that I use, but given that we're talking about all fiat currencies are being devalued around the world and debased based on global government spending and the financing of that spending by various central banks around the world, that does it really matter what the dollar does relative to other currencies? As I like to say, and it's probably not a fair thing to say, but this is how I see it, it's like comparing different brands of toilet paper, right? Does it really matter what the price of one is relative to the other? They're all the same thing. And, comparing the dollar to the euro or to the yen or the British pound or the yuan, the yuan's probably the exception because that's probably got the biggest gold backing. But comparing those currencies against each other, does it really matter? What really matters is how each of those perform relative to hard assets like gold and silver. So could the dollar go up relative to all those various other currencies? Sure. Does it mean it has to go up against gold? No. Mm-hmm. If all fiat currencies are going down against hard assets like gold, it means gold's going up in various currencies to different degrees. Beyond that, who cares what the dollar does relative to the euro, to the yen, etc.?
Mm-hmm. So, David, before we see yields peak, do you have any targets for, let's say, the downside of gold and silver in this, let's say, near-term target?
Well, as I posted today on multiple tweets, there's a whole bunch of indicators that I'm watching per my 5-pest process. And, the bottom may be in for gold here already around 1700. We could go a little lower, maybe 1650 at most. Silver, we could have hit it already. 25, 24, 23 are all still possible. And that would enable the gold-silver ratio to bounce. But as I said, it's just a short-term bounce if we get it. And then the gold-silver ratio is going to continue lower.
Mm-hmm. So, David, as we're talking about silver specifically, what are your thoughts on the silver squeeze, if you could share them with us? And how likely is it that we're actually going to see some, real outcome from this end of delivery month and everything, as we've seen everybody try and buy up all the physical silver that they can to force this bit of a short squeeze here?
Well, first and foremost, I think it's achieved something that's extremely significant already, in that it has brought silver out of the shadows and pushed it front and center into public consciousness. Because the whole squeeze has been widely publicized in the social media and mainstream media. And that's a huge positive for silver. It puts it front and center in people's mindset, especially with regard to everything going on in the world and where do I put my money, how do I protect my wealth, etc. And that's an extremely good thing. I would say that some of the entrants into the space were new and weren't familiar with the territory. Taking on a hedge fund in GameStop shares is extraordinarily different to taking on the bullion banks in the silver space. And they learned that the hard way, but they learned very quickly. These guys are smart. And they learned that the best way was not to take them on the futures market, because they can literally create futures at will. It's to basically take all of the physical metal out of circulation, which they've pretty much done at the dealer level. And I think that will have repercussions going forward. Look, the London gold pool back in the late 1960s died because of mass demand for gold. In the 1970s, silver outpaced gold in terms of gains because the masses woke up to its value. And the reason why I like silver over gold is not only because it outperforms gold over time in every bull market, it's because silver is called the poor man's gold for a reason. If somebody goes down to their bank tomorrow with $2,000, at least here in Canada, and says, hey, I want to buy some gold, how much can I get? They're going to be laughed at because it won't even buy you one coin. Whereas, so they stand there and go, well, what can I get? Well, I can give you probably at least, what is it now? It's I've got $50 a coin now. So you're like, I can give you 40 coins of silver, if my math's correct, and they'll take that. So that's why silver tends to outperform, because when the masses finally wake up, even those that can afford gold, they prefer silver because they can get more of it. And the squeeze that was put on silver has helped in that regard, because again, it's awoken the masses' consciousness with regard to silver as a viable asset to protect their wealth, but not only do that, to make money on it going forward.
Excellent, David. How does oil fit into all of this as well? Do you think that there's going to be a push into more secure, stable energy supplies after what happened in Texas?
This is a good question. I will speak from personal experience. At my property, I have solar, wind with a battery backup facility, but I also have propane. I'm connected to the grid. I have a wood stove. I have a wood fireplace. My point is, I believe there's a place for both. I don't think we should rely too much on one or the other. I'm center in almost everything. I don't believe in extremities of having to go all one way or the other. And there's a place for both. And I think that's becoming apparent to the mainstream as well. So oil is not dead and buried by any stretch of the imagination. And at the same time that they're printing money left, right, and center, I've said, for quite some time now, I think the past 6 months at least, I believe oil is going to triple digits by 2022 at the latest. For the same reason that gold and silver are going up. When you devalue the currency dramatically with all this money printing, hard assets like gold and silver, and we can get into the viscosity of oil if you wish, but it's a hard asset, that's going to benefit as well. So, the recent experience in Texas adds weight to the need to have oil, gas, energy sources. But I believe the printing of money ad nauseum is going to only increase the likelihood that we get triple digits in 2022, as it always does. When you look at the 1970s, for example, when gold and silver skyrocketed, trust me, oil prices skyrocketed as well. They tend to go hand in hand.
Excellent, David. Do you have any concluding thoughts as we wrap up here?
Look, one of the main things that, amongst my tools, they have various degrees of importance for different sectors, for different asset classes. Mm-hmm. So, for example, one of the ones I look at in the natural gas sector that I found to be extremely good as a predictor is the holdings of the other representatives. In other words, how long or short are they? They tend to be very prescient. That's very different to, say, gold and silver and any other class. The other reps are like pretty much non-existent. In gold and silver, sentiment is a huge one, especially in the medium term and short term. Longer term, the fundamentals are the key. But in terms of timing, when to get in and get out, from a swing trading perspective, I don't day trade. Sentiment is key. Despite as many examples as we've had over the past few years, people still make this mistake. They still get too emotional over their holdings, especially in the gold and silver space. What happened last year when I was saying that we were going to get a dramatic pullback from these peaks is indicative of that. Everybody was extremely bullish and didn't want to hear it. Well, here we are. And now we're down here. You got people talking about 1,500 gold, 1,400 gold, 13, which I love to hear because those are the exact sentiments you want to hear at the lows. Everybody is looking lower and lower and lower. Well, that's when you want to buy. And, we can debate how good an investor Warren Buffett is, but he was right when he said you sell when everybody else is buying and you buy when there's blood on the streets. Mm-hmm. And that is when you buy low, sell high, essentially. That's the most basic premise for trading and investing. And no more so than in gold and silver. When everybody is bearish, buy. When everybody is bullish, sell. Now, it's not that simple. If it were that simple, everybody would be billionaires. But it is a key tool to watch. And, I just recommend people try and become more objective. When everybody and their dog is on one side of the boat, it's time to look the other way. And that's one of the reasons why I think the dollar and gold and silver can go up together, because the world and their collective dogs are all short the dollar right now. Well, there's a massive short squeeze. It's ripe for a massive short squeeze. At the same time, gold and silver are getting ready to bottom if we get a peak in yields. So certainly they can go up together. But sentiment is key in the gold and silver sector, and you need to watch that. And when everybody is agreeing with you, it's time to perhaps check the exit doors. And I just want people to be aware of that, because despite how many examples we get, they still repeat the same mistakes and just follow the crowd.
Excellent, David. Well, there's some sound advice from you as always. Of course, we can find you at Global Pro Trader on Twitter, and all of your Sprott Money articles are available. We'll also post that article and links to that in the show notes. David, thanks very much for your time today.
Tom, one thing I want to leave you before I go. Mm-hmm. The risk reward at these levels down here is dramatically to the upside, in my opinion. So whether the low is in or close, you're talking maybe in gold up to $50 on the downside. Compare that to the potential upside of $400 to $600 on the upside. My point is the risk reward is dramatically in your favor. You don't have to back up the truck here. You don't have to load up. But you certainly want to consider deploying some capital into the space, whether it be in the metals or the miners here. And, it doesn't have to be a huge amount. Perhaps less is more, because it gives you more room to wear some losses in the short term, having a high degree of probability that you're going to get paid a few months into the future. So the risk reward here is dramatically the upside. That's the one last point I wanted to leave with your listeners. And thank you so much for having me, Tom. I really appreciate our conversations.
As do I, David. And it's, as you and I always talk about, a little bit of preparation now won't leave you worse off, correct?
Oh, absolutely. I recommend everybody get ready for what's coming, not just in the financial market, from a financial market perspective, but also in your personal life. As I've said when asked, what else do you recommend people do? As Lynette Zhang said recently, and I've been saying for years, shelter, food, water, security, and like-minded people, community. Those are critical going forward, and energy sources are a key one in all of that.
Excellent, David. Well, as always, we really appreciate your time.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.